Good afternoon, everyone. Jordan Volino, counsel for 89 Energy and Land Run Minerals, and wanted to thank OCAPLTA and also LandVantage for hosting me this afternoon. I'm going to talk today about energy transactions and negotiations, looking at modern deals, acquisitions, and contracts in this turbulent world. So for today, a brief overview of kind of the material that I'm going to go into. The contents of this speech will include current market forces and acquisitions, showing what's happening in this market that's been turned upside down by COVID-19 and also the collapsing in oil prices. And then how do we react to that via contracts? Now, even though prices go up and down, the show must go on. And as an attorney, as a landman, or any oil and gas professional, how do you adapt and evolve to continue doing your job at the highest ability and also continue with the emerging market forces? So indications of interest, purchase and sale agreements, letters of indication, LOIs, letter agreements, and acreage trades, and also some examples at the end. And I will be providing those Word documents to go through at the conclusion of this speech. To begin, I always like to look at a market analysis. The U.S. Energy Information Administration puts out an outlook every year, typically at the beginning of the year, typically every January or February. And this year was very unique. As I walk through these next slides, I would like you to notice what our federal government, using very advanced professionals in oil and gas and market forces, predicted what was going to happen. And then we'll look at what actually happened and how we use our contracts that we know and use every day going forward. So with this slide, you're able to see the historical analysis of energy production in the United States and across the world. And also the projections. If you look at the dotted line, you see 2019, 2020, which hindsight's always 2020, funny enough. We're able to see what our government and our professionals that guide this market projected would happen to the production and the price of natural gas, crude oil, renewables, coal, and also our consumption. But this is before we knew what was coming down the pipe. The North Sea Brent crude and also the natural gas price at the Henry Hub, if you look at the slide in front of you, actually was projected to go pretty high. Starting this year, we all expected prices to increase on oil, gas, and renewables. And with the trending of the graph in front of you, you're able to see that in real time. This was, like I said, in January. We expected prices of oil and natural gas to increase. January, February, and March, we expected them to, and they were trending upward. The crude oil production, but at the same time that prices were going up, we assumed that production would level out or actually decrease this year. So it was a perfect storm prior to everything happening in March and April for prices to go up, production to stabilize or level off, and we're about to see what actually happened. With the natural gas production and consumption shown in front of you, countries around the world are emerging from third world to second world to first world, and with countries such as the United States already being a first world country, we were utilizing gas and oil, for that matter, to the highest of our abilities. With the slide shown in front of you, this is inverse reporting, if you can see the date at the bottom, as of February 6th, 2020. I like to show these slides in various seminars and speeches that I give, because they show current A&D transactions and events that are happening. If you look at the location across to the right, you can see the stack, Gulf of Mexico, Midland, the Permian Basin, including the Delaware and the Midland. All around the world, deals are being struck between large groups, publicly traded companies, family companies, and also private equity groups. You'll see assets coming out of Alta Mesa via bankruptcy sale. Other groups around the world getting ready to deploy capital for deepwater gas projects. Other portfolio companies, like a company that I work for, buying, selling, transacting, and merging. But what we're about to see is what happens when the market's turned upside down. Does it affect the oil and gas transactions globally? Does it shoehorn them? Does it synthesize them? Or do they actually stay the same? Continuing, this is still in February, mind you. There are splits, there are exits from the market, there are consolidations. Companies are basically taking non-core assets and shoring up, and this was before the price even collapsed. Bankruptcies had already happened. Companies were moving out of non-core basins and focusing on what was best for the return of their assets to their shareholders or their investors if they're in private equity. But the past two slides is a good example of around the beginning of the year in 2020 what we saw as an oil and gas market. This slide's also very important to note. How does the E&P sector manage and track bankruptcies? There's cumulative bankruptcies, there's new bankruptcies that happen every quarter. And if you can see historically, since about 2016, which we know what happened in 2016, there's been quite a significant uptick in E&P bankruptcies. But as you can see, it's been a slow, steady progression since 2016, with about 34 new bankruptcies immediately happening, follow the drastic price decrease at that time. But as time goes on between 2016 and 2019, you see almost a leveling off. Capital's being deployed correctly. Other groups that are not deploying capital correctly are getting merged, rolled up. Publicly traded companies are, again, selling off their assets, or they're entering into a bankruptcy or restructuring format. Now, this slide, unfortunately, as we all know, is the current world we're living in. Around Q1, Q2 of 2020, oil dropped to prices we've never seen before. It actually went negative. April 20th was a day heard around the world. And leading up to that, oil has already started to trend lower with the COVID-19 pandemic. There's numerous articles out online that you can find across every major publisher, every banking publication and market trending analysis and source. But one I really particularly liked was what Vanity Fair Wall Street in May quoted for what happened to oil and gas. It said it's like a burning theater and everyone's trying to get out the door. They also stated that not only have we been wrong with evaluating commodity prices, we've been wrong on an order of magnitude more than anyone could ever conceive. And that's a very chilling statement when you're in the world of oil and gas, private equity, and banking. But there is a silver lining. What I will show you guys before we move actually into our contract interpretation is there's significantly enough the same amount of transactions happening in this world we're living in now. Very similar bankruptcies, similar groups are consolidating, other groups are deploying capital. And so throughout the difficulties of this year, there's always restructuring, there's always merging, there's always a consolidation and selling off of assets. A lot of capital is actually being deployed since oil went negative. And why is that? Groups that were in a bad financial situation potentially got pushed over the brink. Groups that were very solvent, very liquid, or new rounds of investors have come in to deploy new capital. And so you see, as the business is quoted as being cyclical, the cycle was pushed very fast this year, with numerous bankruptcies being filed, numerous assets transacting. But as we've seen here in Oklahoma, a large significant merger between WPX and Devon has happened only recently, and the market really hasn't got that much better. So it gives me a bit of solace looking at the market analysis currently, as Inverse put out last month in front of you. You'll look similar jurisdictions, similar areas around the world. You've got Mid-Con, you've got the Appalachia, Marcellus, you've got offshore, also Permian, Delaware Basin, all the way up into Kansas and the Bakken. So this gives me actually quite a bit of joy comparing and contrasting the two A&D market reports by saying, okay, how does potentially the most hectic year in oil and gas and commodities, how does that affect our year going forward? How does that affect oil and gas going forward? How does that affect mergers and acquisitions? It's almost forced M&A. Certain groups have to get rid of their assets. Certain groups want to buy their assets. If you are a new investor or have additional liquidity, right now is the best time to buy, even though most reports would say it's a terrible time to buy oil and gas assets. So these slides in front of you now are current market analysis, and I think it's very fitting for our topic that we're talking about today as current negotiations and contracts in this world, that there's actually the same amount of M&A happening. It's just on a different scale. More bankruptcies, more mergers, but throughout that, throughout those processes, there is still due diligence and contracts that have to be reviewed, interpreted, and acted upon, right? If you're in a world consisting of a lot of brokerages, due diligence has to happen in every one of these deals in bankruptcy. So it's a great amount of solace, like I mentioned, to know that even in the worst of times, deals will still go on, and we can still transact and still move on down the road. But we have to evolve, and that's, as these slides are showing right now. I think we're figuring out a way to do that. With this second slide here, it's just like I said, a additional recap of current market analysis and A&D transactions that are happening right now all around the world. And if you contrast and compare the current analysis with the previous analysis of February, before oil went negative and before COVID-19, there's actually a very similar acreage position and a very similar amount of money deployed and transacted. Now, some of it obviously is more bankrupt now, but it's very interesting to note that, because even in good times and bad, contracts and the circle of due diligence has to follow suit. Again, another slide showing bankruptcies. As I mentioned, they are trending upwards. If you can see, since Q1, Q2, and Q3 of 2020, there's been quite a bit of bankruptcies filed, trending into the 18, 17s per quarter. I think you're going to see that over the next couple months and potentially the next couple years as markets restabilize. But with that, as I mentioned, comes a lot of new activity, new players, new companies. Even though one company may go bankrupt, sell all their assets, somebody else is going to initiate a new drilling program, a new round of due diligence, a new round of leasing, to continue developing those assets. Because oil and gas companies come and go, teams, management structures, and investors change, the assets actually still do stay the same. So it's a good point to note. My main point of this talk is why do we have acquisitions following the topsy-turvy slides that I just showed you. Although they go up and down, and we've really missed the mark on quite a few projections, estimations, and evaluations, there are still quite a bit of activity happening right now with my own personal companies and companies that I'm involved with. It's very interesting to see that those who adapt quicker, those who are able to adapt and move basins, pivot, show a bit of resilience in this, still have quite a bit of work to do. And I really applaud those that have. But reasons for acquiring new assets, or reason for entering into contract negotiation, are vast. I mentioned quite a few on my opening slides, but really any reason under the sun can be a reason to acquire, whether it makes sense to your companies and to your investors. But reasons behind mineral leasehold owners to transact or divest might range from a desire to end liabilities. It might not actually be acquiring new acreage. They might want to end future liabilities, plugging liabilities. They want to shift AOIs, or areas of interest, like I mentioned, or commit capital to other ventures. Maybe spend more on mineral buying, spend less on operations, spend less on drilling, more on non-op participation acreage. They might want to take their vast pipeline system or their water gathering treatment facilities and deploy that maybe into drilling more wells. Also, with the depressed pricing and environment that we have, a lot of upstream companies are facing quite a bit of commercial credit lines that are being called upon. A lot of debtors and creditors are having to come to the table due to it being October, redetermination of their borrowing base. A lot of equity lenders, a lot of banking institutions are really looking at their energy debt and their energy books, and with that becomes new M&A activity. Some might be forced to sell, some might have an opportunity presented where it makes sense to sell. Other companies, after an examination of their properties, they might not be core to their position, right? They can reduce debt by selling 30% of their fringe acreage and focus more capital and deploy it within their core area. So all these reasons, as I mentioned, are reasons that companies right now are transacting and divesting. With that, I'd like to note that not all oil and gas property is valued the same. It might be highly valuable for a small private company, whereas a large company with a lot of G&A that's publicly traded, it might not be as valuable to their books because it doesn't give the return that a large-scale project would lend. So with that, companies can use the same asset but actually have quite a bit of different rates of return, and I think that's why you're seeing transactions right now. A larger oil and gas company or an operator might deem a producing interest not to be profitable based on the lifting cost that it has. It's got a lot of financial yield performance requirements where a smaller company might not have that. A smaller company's operating expenses might be 30 to 40% of a large publicly traded company. So therefore that well is still highly profitable to a small player where it might not be to a larger company. If a smaller company may think that it can trim down operating costs or economically develop the well with cheaper lifting costs or other expenses, then it might make more sense for that company to go out and seek to acquire various vertical wells or various acreages that larger companies have put together in the land grab that we've seen over the past 5 years, where those larger companies aren't necessarily valuing them the same that they were when they paid for that leasehold. And then on the inverse, a smaller company may own a very profitable asset, but they might have too much debt or cannot deploy any more capital to develop that asset. There are numerous clauses within leases and contracts that require development, being continuous drilling clauses and other clauses in various agreements, state, federal, or fee, that require development and even pressure from landowners. And so smaller companies might divest for that reason, whereas a bigger company can come in with more capital, more G&A, potentially with a budget for that area, and work over new existing wells or drill new ones. This slide right here, I think it's a very good example of the cyclical nature of our industry, but also the cyclical nature of new ventures. This quote at the top I think is very comical, but I think it's very telling when dealing with contracts, which is a large part and parcel of what I deal with. It states, it's actually a cartoonist, but the fellow that agrees with everything you say is either a fool or he's getting ready to skin you. And I've been on both sides of that knife. If someone agreed to my price that I was willing to quote for the sale of an asset without any hesitation, it makes me very nervous. I've also been on the other side where I've immediately agreed to someone's price because my evaluation came back a lot higher than they were selling it for. So it always makes you pause when no one counters. But even if they don't counter and you proceed with an acquisition, there always are the same similar steps throughout, right? You've got the acquisition phase, the scouting phase, new venture phase, where companies are constantly evaluating assets to determine if it's a worthwhile venture. Not every oil and gas producing asset is worthwhile, but almost every producing asset is worthwhile to some company. And at that time when companies are shopping around looking for new details, new ventures, or maybe new assets to acquire, a lot of confidentiality provisions are agreed upon so data can be shared, right? If you were very interested in buying something of mine, you might have an idea of what I own and how it performs based on public data. But if you really want to dive in further, you might say, hey, Jordan, I'd really appreciate a look at this. If you're willing to sell, can we enter into a confidentiality agreement so that I can get more data to determine if it fits my company or fits my budget or fits my return structure. Once a company has actually looked at a little bit of data past the confidentiality stage and has dated a little bit, then we basically get to what's known as the drafting phase. LOIs, IOIs, PSAs, letter agreements, depending on what you're doing and how big of the acquisition you're interested in acquiring, determines what you actually need to draft. And we'll go through that here in a little bit. But forms and terms are determined by parties, warranty, timing, due diligence, effective dates, curatives, and most importantly, price. Once those terms are fleshed out and everybody seems comfortable with moving forward at an agreed upon price, then the due diligence phase happens. And that is typically where all the skeletons are found, if there is any. Both sides undertake due diligence. Some files are shared, other files are sought after on their own. Ownership reports, title opinions, environmental impact statements, NEPA analysis, depending on where you're at in the country and what type of land it is. But liabilities, probability of success, defects are all discovered at this phase. Curative measures are asserted and taken. And then once that due diligence period has actually ran, there is always a closing statement. Parties agree on what is the final closing numbers, being net royalty acres, net mineral acres, purchase price, whether that's gone up or down after due diligence. And then we come to closing the deal. And once we get to closing the deal, we wish that it was as simple as signing a document, but it's not. There is a lot of taxation issues we have to cover. There's a lot of transfer of assets we have to cover depending on the size of the deal. A lot of letters in lieu, a lot of division orders go out, and as you're very well aware, this can take quite a long time to get an asset transferred from one company to the next, but it's obviously the big bow that we all wish to tie there at the end of the deal. So, as I mentioned, we've had quite a few slides thus far that have shown what is happening in the market, how it happens in the market, and so I think now it's a good time to go into these forms and these ideas that are used in contract interpretation and drafting to see how we get there, right? We've got a deal, we're interested, but how do we proceed? Because not every deal uses the same form, and if a lawyer or a company tells you that it should, well, they're definitely wrong. I can tell you many stories where I've entered into a very small deal and spent more time negotiating the contract than the asset was actually worth. You get a lot of very angry clients when you do that because the bill starts to skyrocket. So there are a lot of different avenues that you can proceed with transacting on an asset, and I'm going to walk through a couple of them now. Indications of interest are my favorite tool. When someone's marketing an asset, or someone has an asset that they're interested in selling, or maybe they're not interested in selling, but you're interested in buying, you can do a soft bid or proposal, and you can send to them and basically say, I'm willing if you're willing. We're interested in your asset. We're interested in maybe forming a joint venture. We'd like to talk about more terms, and if they are interested in hearing those terms, an indication of interest is probably your best tool, right? It's basically a bid or a proposal stating that if I'm interested, if you're interested, we're interested. And so this is the dating phase. When assets are marketed through third-party clearinghouses or marketing companies, this is typically the best way to proceed. You throw out a bid and say, we're willing to transact at X price. Obviously, that's subject to financing contingencies, effective date, board of directors approval, management approval, but it's a one-page flyer typically that says this is tentatively what we would agree to. If you're interested, we can proceed. And that saves a lot of time for everybody. You don't want to mark up a large PSA, a large purchase and sale agreement, if the parties aren't agreeing to a price. And so I think that these soft bids proposals or these IOIs are very useful, saying this isn't binding, this is contingent, but if you're interested at this price, we can proceed. And once that's been accepted, typically we move into the formal letter agreements that I'll now discuss. So a purchase and sale agreement can take many forms, it can take many shapes, and I'll discuss quite a bit of them here in a bit, but they typically have a lot of the same contents that can be redacted throughout. Now, this is typically where the lawyers come in, or the landmen, whether it be a land manager or VP of land. A lot of companies have typical structures that they'll agree to, typical terms that they won't agree to. If I make specific performance and full indemnity on your behalf to me, part of the deal, well, your company's probably not going to agree to that. We don't even have to go down that road if I'm not willing to budge. So typically you'll get a boilerplate contract, and a lot of contracts are boilerplate in the sense, when I mean that term, they're standard forms. A lot of the terms have been negotiated prior to transacting, and so there's a lot of legalese that's thrown in these contracts because it has to be. Things on jurisdiction, effective date, parties, severance, and typically your miscellaneous provisions at the end of contracts. Like I said, those are pretty standard, and you really won't negotiate those a lot. But walking through the contents of a PSA, and this can be a very short one or a very long one, you're going to have the introduction, the scope, introduce the parties, what you're doing at the table, transacting on working interest, buying wellbore interest, buying X amount of net mineral acres in the Delaware Basin. You have to have an identification of the parties for valid contractual terms under the law. Definitions in construction, like I said, what are you doing at the table? What is this contract meaning to provide to the parties and also the successors in interest. I mean, a contract, once it's been validly executed, does hold a lot of legal weight, and there are certain ways to get out of them, but they were executed and negotiated for a reason. One of the biggest issues with oil and gas contracts is improper description of assets and interest being sold, right? Oil and gas interests are assets, working interest, mineral interest, royalty interest, and so when we transact, we're basically transacting on those interests. So that's going to include your leases, your base leases, and your leasehold if it's HBP. Even if it's not HBP, you might include your leases that are currently being held in their primary term. Wells, if wells are held by production including before and after effective date, how that transfers. Equipment, the contracts that run with the land, easements, permits, and other surface rights and other encumbrances. Records, including title, data, other information systems, and then the excluded assets. The purchase price adjustments and values obviously is the linchpin of the entire contract. If we don't agree on the purchase price, then we won't have a contract. But typically, this form of PSA, specifically in oil and gas, operates a lot like real estate closings. You're going to have a deposit, typically price adjustments up and down based on defect, closing, post-closing, accounting, taxation, and other things that both lawyers and tax professionals have fought over for a long time. The representations and warranties of seller and buyer. This is a very important facet of all contracts because this gets down to the meat of what you're representing and warranting on both sides of the table. If you don't represent and warrant anything, well, that's effectively a quitclaim deed, and we know that we're not going to transact on $20 million worth of assets with a quitclaim deed. So throughout the representations and warranties, there are certain duties and liabilities that both sides agree to undertake to proceed with the transaction. As I keep going, I'll dive further into some of these contents so that you guys can get a bit of a feel for them, but I'm still going to move very quickly. The representations and warranties of buyer, there's a lot of pre-closing covenants, a lot of covenants of solvency, of financial backing. If you are buying an asset, you're warranting that you have adequate legal authority to buy that asset. You do not want to get to closing and realize that you don't have any money in the bank. So you are repping that you are, in fact, a ready, willing, and able buyer, and able being financially solvent, legally solvent. You're not bankrupt, you're not running a Ponzi scheme, you don't have a fraudulent shell company, and various pre-closing covenants on both sides of the table. Records, further assurances, public announcements, these all need to be discussed in the middle of due diligence, in the middle of a PSA. We don't want really either side to make a public announcement unless it's been agreed to. Records, that ties back to the confidentiality, and typically they're merged together. A lot of records are passed back and forth digitally these days, but there's a lot of covenants that touch on those. Representations and warranties of seller, and I'll go through these, are a little bit more than the buyer because the seller has a bit more duty and liability. Obviously, they own the assets and they're intending to liquidate them. So what representations and warranties do we want to see from the seller? So enforceability of the contract. A, can they enforce it? B, can they sell? You would hate to get down, spend all these money in legal fees and brokerage fees to find out that the seller actually can't transact due to some clause in their management structure or board of directors haven't approved it yet. So these are representations that we want to flesh out early on. Pending litigation. This is very, very important in larger deals. What assets are tied to what litigation? That doesn't necessarily have to be quiet title suits. I've been involved in acquisitions before where there are pending litigation based on a nuisance because the drilling pad was too noisy. There are frac crew operators that have been hurt on a job site, have sued the insurance company and also the operator. So any pending litigation while you are buying an asset needs to be fleshed out so that the buying party can review with their internal counsel and external counsel to decide what they would like to waive or require the seller to deduct from the purchase price or set aside money. Approvals and pref rights, very, very important, especially in Texas. There's been quite a bit of preferential right litigation all the way up to the Supreme Court, even as late as last year, or as recent as last year. If a pref right or a right of first refusal runs with an asset and that asset's sold and that right is not exercised or even notified, there can be quite a bit of litigation that follows. So we have to flesh those out during due diligence. But as a buyer, you want to require that on the seller to notify you of everything that they have knowledge of. Contracts, expenditures, wells, title, and environmental impact statements, and other NEPA analysis, as I mentioned earlier. With oil and gas assets, we typically find that they are not in the most easily accessible of places. A lot of rivers run through a large development. You've got a lot of zoning that has to be addressed, air quality that has to be addressed if it's next to an airport or next to a town. And so those environmental statements need to be provided and warranted as well. Taxes, bankruptcy, and typical compliance laws. Representations and warranties of buyers, I mentioned, I'll go into quickly a little bit further, but the pre-closing covenants by both sides, and really what you're going to see addressed by the buyer and what they will negotiate the hardest is title. I've previously, when I practiced law before I was internal counsel, performed a lot of title examination for a lot of large operators, and title opinions and title due diligence by brokers are paramount in any acquisition. So when you're on the buying side, you want to know what's a title defect. How can you determine a title defect? How can you assert a title defect? What are permitted encumbrances such as easements, right-of-ways, other encumbrances that the sellers let you know of? Maybe title defect values if there's an allocation schedule. Title defect thresholds if there's some sort of deductible or cap. All these things can be negotiated. Seller's response to title defects, whether or not a third-party referee has to come in and negotiate or arbitrate title defects, title benefits, walkaways, or reasons that an individual such as a buyer could get out of a PSA, and then the warranties and the conveyance. And typically a lot of negotiating is had during this phase because the seller, for the most part, has quite a bit of title on their assets, or we hope they would, but the buyer has not started due diligence yet. And so this is the area that can make or break a contract. And typically in negotiations, there's a lot of industry standard usage that is applied. But if you've got some defective acreage and you're really trying to sell it, it can be pretty heated negotiating these matters. Environmental matters, as I mentioned, I won't go into those again, but conditions of closing. Once we hit all of due diligence, there's going to be a set of reps and warranties and provisions that are conditions to closing. Once we accurately hit all of the representations on both sides, we've cleared title, we've cleared due diligence, we feel comfortable, and there isn't any new litigation that's popped up, then we go into the actual closing obligations, which include conveyancing documents, division orders, the closing amount, getting lien releases, getting mortgage releases, letters in lieu, certificates if it's a merger or an acquisition in another state, non-foreign certificates, and corporate approvals. Termination. Unfortunately, these contracts don't always go as planned, right? The assets aren't as good as we expected, or as we're seeing a lot with this year, prices of oil and gas change. I've seen more companies try to get out of contracts at the beginning of this year than I potentially ever have in my practice. Why? Because when they evaluated the asset at the end of last year, the beginning of this year, and they put a certain purchase price, sticker price, that the buyer was willing to accept, no one expected oil to go negative. No one expected a worldwide pandemic. And shockingly enough, you can imagine the contracts that I see right now include events of termination not consisting of worldwide pandemics, not consisting of market forces or commodity prices, which is very interesting because now we have actual knowledge of that. It's hard for me to agree not to allow a contract to terminate if oil goes negative again. But if you're selling, you obviously want to assert those. Indemnities, miscellaneous matters, survival of representations after you sell the asset are additional provisions as well. So once we've entered into a PSA and we've negotiated all the terms, we're starting due diligence, we typically forget that there are contractual rights that go along both sides of this document. Obviously, we don't think about those contractual rights until a deal falls apart and we're starting to entertain litigation. But with most significant transactions, the parties are going to agree well in advance of all the obligations, representations, because they're legal contractual provisions relating to the term of the transaction and the parties' rights and duties both before and after the transaction. These obligations are completely revised and basically put into the PSA, making its final form. And upon execution, we have a valid legal relationship. Definition and construction. I've already gone over a few of these things, but I want to mention them one more time. Typically, there is an organization to a PSA. They flow in a manner that's a lot similar to other legal documents that you may see. And with those defined terms, there's things that you can expect, but unfortunately, I've seen quite a bit of people or deals that are smaller in size, individuals breeze through contracts because they don't think, well, it's a smaller deal, we don't really need to go into that, we don't need to spend a lot of time revising or redlining, we just need to hit the high marks. And I think a lot of detail is left in the weeds, or unfortunately a lot of terms, if they're redacted or left out, still have active valid control under the law that parties don't think about. Description of the assets being sold. Because oil and gas is an asset-based business, it's very, very important to understand how and why to describe these assets. The clause, obviously a seller agrees to sell, buyer agrees to buy the described assets, typically on Exhibit A if it's more than one section of land or more than one small asset, but it also can be quantum, and I've seen a lot of title attorneys and due diligence miss. It says all right title within the granting clause, but further down there's a quantum of interest saying only 90% or only an undivided X percent in certain formations as described on Exhibit A. So you really have to read these contracts front to back, because the legal descriptions are highly problematic if something is incorrect, right? There's a lot of scrivener's errors, we're all people, but these legal descriptions seem to get longer and more complex as all the depth severances, MPRI issues, back-end issues that have happened over the past 30, 40 years. So you really, really have to do a double take or a triple take when constructing these PSAs, including the lands, leases, and wells, and making sure you have them all. I can't tell you how many assignments I've seen that don't match the PSA because they used a different spreadsheet or a different formula when transferring over. And so you've got a contract conveying $20 million worth of assets. Well, once the conveyances are drawn up, sometimes they're quickly drawn up, sometimes they're not read with due diligence, and they'll miss lands, leases, and wells. So then what happens as an examiner or as a broker when you're going back? Did they mean to include it? We don't know. And you likely cannot contact those companies because they might be bankrupt, they might have merged, or they might not exist anymore. The excluded assets, very important to note as well, based on one of the most important and most expensive pieces of information we can have now, which is data, which is title. Title can flow either way depending on how they're excluded in the agreement. Associated agreements with the PSA, that typically is the end-all be-all of the contract, but that's not your only contract. That's not the only contract you're going to use throughout this period. A confidentiality agreement, as I mentioned, is typically your first agreement. That's an agreement not to discuss the terms and provisions with the deal with other parties or the data with other parties, especially in today's age. Data is, like I mentioned, the most valuable. So non-disclosure agreements protect non-public information that either side has paid a lot of money for. Term sheets. Term sheets are unique because if we don't use an indication of interest, we might use a term sheet instead, and it's basically a high-level roadmap structuring the formal process, saying we'll pay this price if we hit these benchmarks at this threshold, if we conclude due diligence at this date, and other factors that might be figured into it. But term sheets are kind of synonymous with indications of interest, but used as well in the business. Letters of intent. Letters of intent I like to use, which I'll show you guys in a couple slides. I like to use them as more informal PSAs, but still with a lot of legal basis. If you have a 40, 50-page PSA for a $100,000 agreement, well, that seems a bit overkill. Unless you've got something that you don't want the other party to know about, typically you can get by with a couple-page PSA, which I'd call a letter of intent, right? It's an LOI, it's a short-form letter agreement, and as the business is proceeded, and unfortunately everybody's got Microsoft Word. Sometimes these are misconstrued, but they are very helpful, so we can get away from massive amounts of legal fees constructing, interpreting, and redlining 30, 40, 50 page PSAs. And then transition agreements after the contract is closed, after the sale of the asset is closed. There is quite a bit of documentation that we still have to go through. Revenue, accounting, that's where we get our tax lawyers in, that's where we get our accountants in, and work with you guys on division orders, letters in lieu, and contacting the operators. Unfortunately, they don't put us in pay as fast as we'd like, but we do have to contact them and follow up with quite a bit of documentation, or known as those transition agreements. So the letter of intent, like I mentioned, it's a short form agreement, and I've actually provided an example which will be provided to you. I think that LOIs or small letter agreements are actually very, very useful because, like I said, you can use one and transact very quickly, and you don't have to get into the weeds of high-level indemnities, taxation, or potentially deductibles on smaller deals that only might consist of $50,000, might consist of $200,000. But if you are engaging in a smaller deal, they are very helpful because they can move the process along instead of stalling out a multi-week negotiation on a long PSA. If the parties want potentially an LOI or a small short-form letter agreement to be more complex, obviously you can use a PSA at any time. This letter of intent, or like I said, LOIs, very short, two pages rather than 20 to 30 pages, but it's going to have your basic contractual terms. If it didn't, it wouldn't be a contract. So parties, legal description, typically shown on Exhibit A unless there's a very small amount. Due diligence, whether or not we want marketable title, defensible title, and what that looks like. What happens if title does not meet that threshold. Purchase price, and you'll see a limited amount of liabilities, warranties, stated in these LOIs. They won't be as serious or as vast as your longer PSAs, but they still allow both parties a lot of comfort in transacting and the legal protections that come with that comfort. The acreage trade. This is very interesting because although we've got PSAs, LOIs, IOIs, and every other conveyancing document, this has really been born in my opinion, as of the past few years, with companies not necessarily wanting to buy or sell, but wanting to consolidate and shore up their interest. And how do you do that with a competing company? Well, you can either buy, sell, or trade. And with that, I've seen quite a bit of acquisitions move more towards trades over the past few years because of the biggest white elephant in the room is capital, right? If capital is not available to be deployed, how can you go forward still planning, still marketing, still operating under a budget? And like I said, if there's no capital, you can't buy. And if nobody's willing to buy, well, nobody's willing to sell. We still have operations that need to be consolidated. We still have units that need to be put together. And the business, as we all know, doesn't stop just because you ran out of money. So the acreage trade, I think, is a pretty ingenious device. I've negotiated quite a few of them, and they're exactly what you think. Basically a PSA that says, you trade me this, I trade you that, for no money, and it's actually allowed under the Internal Revenue Code and federal taxation. But with that, new statutory language has to be included, boilerplate language has to be included, and the company actually still has to agree. So it's more of a buy-sell and more of a one-for-one agreement. But like I said, this acreage trade allows companies to get out of each other's way from a regulatory standpoint, which can be incredibly valuable in itself. It can be really complex or simplistic depending on what you want to do. I've seen acreage trades that are 1 unit for 1 unit. It might be I give you 20 acres, you give me 20 acres, and you stop protesting me at the OCC or the Railroad Commission. Other larger scale trades can change basin economics completely. You could say, well, I'll give you 1,000 acres on this side of the basin, you give me 1,000 acres on your side of the basin, and we've now effectively drawn a line in the sand without engaging antitrust issues at all. So it's a pretty unique tool that I'll provide a statutory form that I've kind of drafted up that really allows you to keep moving with no budget. So I think it's very unique, and I'm interested to see how much acreage trades will be used going forward. With an acreage trade, though, the recitals are going to be a little bit different. If you've ever entered into a PSA, which I'm sure all of you have, you typically understand the contractual terms that we talked about initially. So those contractual terms and covenants are seen in real estate acquisitions as well. A lot of oil and gas law comes from property law, which has been passed through common law from England. So a lot of those terms have not actually changed. But the acreage trade being more in vogue and in a bit of an infant phase, the recitals are a bit different. So here's an example on your screen right now. Basically, you're going to recite Black Oil Co. As Exhibit A, Delos Energy as Exhibit B, and then you have to recite we are trading under Section 1031 of the IRC an acre for acre. Well, as we know, not every acre is valued the same. Not every acre has the same revenue or royalty attributed to it. So the companies have to go in and agree how to value those leases, and that's typically based on a net royalty acre rather than a net mineral acre. But once we do agree that the acreage traded, and that's typically where you spend most of your time on the acreage trade, is going back and forth potentially for months on what is a lease worth and what is your lease worth compared to mine. And it might not even be one for one. A company could trade 600 very valuable acres for maybe 1,200 less valuable acres if it makes sense to both parties. But the recitals, you're going to see them in the acreage trade agreement. They won't be the same as a PSA, but get the job done either way. The valuation, this is probably the most important part. As I mentioned, you go back and forth evaluating these leases throughout initial due diligence proposals, and typically these acreage trades start with an indication of interest. You say, hey, we've been fighting each other at the OCC for a long time now. Why don't we get out of each other's units and let everybody drill, which back when there was a lot of capital was ideal. We could not spend any money on fighting on leasehold and rather just trade into it and then proceed with our own respective units. But here, as shown on the screen, as I type this template out, basically Black Oil is our grantee here, or our tradee, shall deliver to Delos on the form assignment, which also shall be negotiated, all interest as to all debts, which isn't always the case, but that's what we agreed to here. 300 net acres in the leases located in. Then you're going to describe your lands, right? If it's a unit for unit, 300 for 300. But the valuation recitation is very important, because that's when we're going to go into and say, okay, it's 300 net mineral acres, but that's actually 243.75 net royalty acres as shown on the Exhibit A schedule. And once that's agreed to on the parties, that valuation is allowed, as mentioned, under the IRC, because some of these companies, if you notice, are publicly traded. And so how do you have stockholders that you're accountable to, and yet you're trading your acreage without actually acquiring any value? So with that, there has to be an allocation valuation schedule, so that for accounting purposes, every dollar spent on acquiring a lease can be allocated to that same lease when you are trading into a lease. But with the acreage trade, similar to the PSA and similar to this whole speech, everything's cyclical. It's going to also entail due diligence, title verification, midstream issues if somebody's land is dedicated, if somebody's land is not, asset exchange, if any wellbores right along with the trade, or any additional data, coring, well samples, title. And then you're going to proceed with the standard format of the PSA with closing, post-closing settlement statements, transfer orders, and division orders. So throughout all this, I like to mention that our business is cyclical, contracts are cyclical, but work orders are also cyclical. Even if it's a short form letter agreement only having a small amount of capital behind it, or it's a large scale PSA that's 60, 70 pages. Some of the PSAs that I'm currently negotiating are in the tunes of 40 to 70 pages, and they take weeks, months, even years to get these across the finish line. Or even a trade agreement, they're all going to entertain the same due diligence, same verifications, same work orders, which we all like to have. Obviously, we wouldn't do this if we didn't. But knowing that, it brings me a bit of hope for the future, because regardless of how we structure these M&A deals, regardless of mergers, bankruptcies, trades, due diligence in this work has to be done. And obviously us as oil and gas professionals, that's exciting to hear, right? Our jobs aren't going to stop tomorrow just because somebody moves from a merger acquisition to a bankruptcy. Now, it might change the company or client you're working for, but the work will still go on as expected. To conclude, when in doubt, a more formal structure with more protections always should be used, unless the dealer situation dictates otherwise. I mentioned throughout the speech, it's always deal specific, right? You might have a small transaction including a couple leases, or you might be acquiring an entire company's portfolio that you'll need to take a hard line look at a long and lengthy PSA. But the worst thing you can do, and really the only improper thing you can do, is rush through them, right? Always consult with your landman, your attorneys, your internal counsel, and when in doubt, use external counsel. I know people hate paying those bills, especially in this commodities environment, but the risk tolerance level for every company is different, and so it's hard to use a standard form throughout. But your internal counsel, external counsel, or management team will know. And with that, like I said, every deal is not the same and should be evaluated outside of the bubble that typically people like to use. The size, structure, liabilities of a deal, you obviously want to value when picking what path of agreement you should start with or proceed with, or basically the other party's agreement on which structure to use. Like I mentioned, the oil and gas attorneys in this state and many others, especially Oklahoma and Texas, so the ones that I've worked with, are fantastic. I won't put myself at the top, but I will say that a lot of complex oil and gas situations can be resolved through the minds in this state and surrounding ones. So anytime you have a question internal with a company, or even asking your mentor what agreement you should use, whether it be an asset acquisition or an acreage trade, always reach out. I mean, this business is a family, and that's why we all work into it. With that, I'm going to go into now a couple of the agreements individually and show you guys a couple provisions that I'd like you to focus on. But at any time throughout, I've left my number, my email at the end of this presentation, and it'll be provided to you all. At any time, for any reason, you're always welcome to reach out to me. Really wanted to appreciate you guys for being here today, and thank you for listening.